Joining us now with his reaction to the inflation data, Roger Ferguson, former Fed vice chairman and now a CNBC contributor. Here's what I was thinking, Roger. So the inflation numbers look tame. Let's say that the labor market, there were no signs of it cracking, and we call it what it is. It's 4%, 4.2, whatever it is. Just because inflation is tame, does that mandate Fed cuts? Or do you need to see that there really might be some cracks developing in the labor market? Because I could still make a case that you don't need to rush on this with where the economy is, the stock market, and even where the labor market is.
Well, first, good morning. I agree with the general sentiment. These numbers were good. To answer your question, Joe, I think the Fed should still be in a position where they are signaling cutting, because as inflation comes down, remember this thing we often talk about, the so-called real rate, they don't want to have that rise. So they don't want to be in a position where they're not reducing interest rates as they see inflation coming down, because that would, in terms of interest rates minus inflation, be a tightening cycle, which they're not interested in. So even if labor markets stay relatively tame, I would expect them to continue on the path that they've outlined, which is more cuts this year. Where they end up is anyone's guess, but certainly I'm in the camp of 2 more cuts this year, seem much more likely than not.
All right, then there's no question that we're in restrictive territory right now, and that for those that would like to keep some, we talk about it all the time, keep some dry powder, whatever it is, keep something in reserve. Doesn't seem like, it doesn't seem like we're that restrictive on a historical level, but we should still assume that there is a little bit too much. It's a little bit too tight at this point in terms of condition.
I think that's a fair statement. To give you your due on your side of the discussion, GDP has come in at roughly 3%. I think the GDP now from the Atlanta Fed is still roughly 3%. That clearly seems like it's above potential growth, for sure. On your side of the discussion, unemployment, while it's ticked up, is still, starting at the 4 handle. So that seems like it's more full employment than a labor market falling apart. And so, there are going to be some arguments on both sides. But at the end of the day, I think there'll be a strong consensus to keep moving. 1 or 2 more cuts this year, I think, should be baked in to market expansion.
It's a tough. It is, the dual mandate is very difficult to try to navigate. It does seem to imply that there's no concern that inflation might somehow come back at some point, and I don't know whether we need to worry about the Middle East or China.
Look, there are a lot of things.
Think about China rebounding. Think about there are some concerns that we haven't driven the stake all the way into the heart of inflation, and it just seems if you got 42 record highs in the S&P this year, it just seems like a weird time to be flooding the system with
Yes.
more cheap money. It seems weird.
No, Joe, I hear you, and I agree to some extent that financial conditions are also not unduly tight, but inflation is coming down. I don't think it's hard to manage the dual mandate.
I don't know if we are tight. I don't know. You have to assume that to go another 200 basis points.
Well, look, I think all the evidence is that we are tight. We don't know, to your point, we don't know how tight we are, which is why I think a series of 25-point moves seems like it's a reasonable thing to do. And we'll watch the incoming data. The Fed has shown an ability to move quickly if they have to, if they think they've gotten it wrong. So I would not dissuade them. I would not discourage them from exercising the strategy they're talking about. And I would certainly not support the notion of keeping a little in reserve, just in case. They can always move back up if need be, and I think the better thing right now is to attempt to engineer the soft landing by allowing rates to move down from restrictive territory to something that's clearly less restrictive, though we don't know quite how much exactly we are in restrictive territory, but we certainly are not at easing territory or easy territory at these levels.